Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to Bloomberg Businessweek with Massar and Tim Stenovec on Bloomberg Radio.
Carol Massar along with Barry Ritholtz. We're live from Future Proof in Huntington Beach, California. Bloomberg's live broadcast from Future Proof is sponsored by JP Morgan Asset Management. Our next guest is a lawyer. Recognized successful financial planner who's been given various accolades.
I thought you were going to say sex symbol for a second. I was
like, I don't know. Maybe that's Bloomberg
Not
After
in front
Dark.
of his wife. Carol, come on.
Been named as top independent financial advisor. You've thrown me in America by Barron's for several years in a row. Co-host the Down the Middle podcast. A New York Times bestselling author. Fresh off the ocean stage here at Future Proof. See, I can't even get it out. Talking about what he has done, how he has achieved success. Let's get to Peter Mallouk, President and CEO of the RIA Creative Planning. They've been recognized, as I said, among the top RIA firms by Barron's and the financial firms. You've got, what, $300 billion in assets under management end of last year?
That's right.
How's it going?
Things couldn't be better. Nothing to complain about.
Is it really? No, seriously.
Yeah, things are fantastic. I think a lot of
running a firm or just money coming in.
Well,
or
I think
both.
You can't be running a firm and having it going well if money's not coming in. That's ultimately the sign that the market likes what you're doing.
Right.
And so the one thing I look at every day is are people coming to creative planning, and that net inflow tells us that we're doing the right things. And so we're really looking and saying for that ultra fluent client or that high net worth client, are they hiring creative planning many, many more times than they might have money leave? And if that's the case, things are going well.
And, you know, when I first met Peter back in 2018, 2019, you were still a reasonable-sized firm, but you were like $40 or so billion. Right. 5 years later, nearly a 10x. That's a giant gain. How have you been growing the business so successfully? What has made creative planning such a force in the industry?
Well, I think for the end client, we're known for working with that high net worth investor that has the $1 million or $2 million. But we also have 1,600 clients that have $25 million on average with us. And that group is the group growing the fastest, but both of these are growing at a rapid clip. And I think that they like, number one, you see people moving from brokerage firms to independent firms. They're also moving to larger independent firms where they know there's more services, there might be more due diligence, better cybersecurity, all of those things that give those high net worth clients comfort. And they also like the specialization of services we have. We look at the investment portfolio through a tax lens and an estate planning lens, and the world has gotten so complicated that if someone's got 500,000 or 50 million, they tend to value that more than they did a decade ago.
So talk about that. You use the phrase that I'm very much enamored with of being the quarterback for their entire financial life. What does that mean to the average creative planning client?
So like a creative planning client knows, okay, they're not just going to take my money and say, this is my age or this is my risk tolerance, and I'm just going to go invest in ABC.
Plug and play.
Right. They know that's not happening. So they're coming to us saying, okay, this is a firm that's going to have a certified financial planner, figure out where am I, what am I trying to accomplish, what state do I live in, what's my tax bracket, what's my legal situation, what am I trying to accomplish? Am I charitably inclined? Do I want to leave the biggest inheritance possible to my kids? Am I short of retirement? We go through this pretty long multi-meeting exercise to figure out, well, where are they and what they want to do, and then we construct a portfolio that we think has the highest probability of creating the outcome they want, taking into account what's already going on in their life. If they own a bunch of real estate, they're not going to get real estate in the portfolio. And I think that customization, then adding the tax sensitivity to it, really being able to help them have a much better return on an after-tax basis, I think higher net worth people appreciate that approach, and I think we're sitting at the center of that.
We mentioned sexy earlier, but how much of your investors are looking for, especially the higher net worth individuals, are looking for sexier investments? And especially, I think about the private world, private credit,
right.
private equity, but especially private credit. Are they pushing for something with something more?
Yes. So we do, at Creative Planning, we're a very big believer in private investments. So we do use private equity, private credit, private real estate. Private credit has obviously kind of taken the world by storm, and I don't know that people fully appreciate the risk reward there. I'm a big believer in private credit.
We
I
talked
just think
about
it needs
this
to come
yesterday.
with a lot of explanation to people to really understand. And private credit's it's like saying bonds. There's all kinds of bonds, all kinds of different profiles, and so really understanding what you're getting into is a very big deal. But a lot of them want those types of investments or hedge funds. We're not a big believer in hedge funds, so we don't use them. But I would say as the higher net worth you go, the more demand there is for private credit, private equity.
I want to ask you, do you think private credit should be available to the masses, whether it's even fractional ownership of some sort?
I think if you have semi-liquid, I don't like that word very much. If you
Yeah.
have things that people can get out of every 6 months or every year, then I think these sorts of investments should be available to people that have less money. I mean, this idea that you have to be a qualified purchaser and a accredited investor, I think it made sense 5 or 10, maybe say 10 years ago.
Right.
When these were tied up for 7 years and you had to very, very sophisticated to understand it. What happened in 08, 09 is the government really pushed credit out of the banks and into the private markets. They didn't want the destabilization of the banking system. Banks said, can't do the due diligence to do this. Now, if you look at firms with revenues of 25 million to over $1 billion, 83% of their borrowing is coming from private credit. Basically, these 8,000 public companies are now only 4,500 or so. Private companies can stay private longer because of all the private credit available. So it's become a very mainstream asset class. You can't freeze out the average American from that.
And growing really fast. This is probably the fastest attracting cash. Maybe crypto at various times in its cycle is a little faster. We've seen it certainly explode and then pull back. But private credit seems to be growing so rapidly. What percentage of someone's portfolio should they be thinking about for private credit, especially in both the mid-level and the high net worth level?
So I always start by telling clients, like, there's really only two investments. You're an owner or you're a lender with everything, right? And so when you're a lender, the next question becomes, well, how much of my portfolio should I be a lender? Because you really accumulate wealth being an owner, whether it's private equity or stocks or business or real estate. And a lender is more preservation, or you know what your income is going to be, but you can't compete with being an owner. That's why the Forbes list is full of owners, not lenders, right? So but if you look at that private side, then you could say, well, what part of the private, of the lending side, what part of the lending side of my portfolio do I not need access to for the next couple months or couple of years? If you've got money that's years out, that's the part of the lending part of the portfolio that can be private credit. And that's how I back into the allocation.
Do you think it becomes much more accessible, I don't know, in a few years? Like, what does it take?
Oh, I think it's happening at lightning speed. I think we're at Creative Planning, we're starting to add private equity into 401k plans. We'll be one of the first firms in the country, if not the first, to do that.
Really?
I think private credit is going to come very, very quickly thereafter.
Oh, fascinating. What about the crypto area? What do you think is the next chapter? Are your investors, are they interested?
So people are interested, of course. I think
Crypto
Is it
curious.
is it a toy? Yeah. Is it a toy or is it something?
Right. I think 99.99% of crypto is going to go to zero. You'll wind up with, somewhere between.
You don't think Dogecoin has some viability? Forgive me.
Right.
Some people say, not my opinion.
I think there'll be like 1 to 3 winners.
Yeah.
If at all, right? And so I think it's a bet. It's speculation. You can't buy any cryptocurrency and say, I believe that 10 years from now, with certainty, that my wealth is still going to be there. But I do understand it's an asymmetrical risk, because the winner is going to have to go up 100-fold. The losers go to zero. There is no in between.
Yeah.
So I consider that speculation. Speculation's different than investing. And there's nothing wrong with speculating if you know you're speculating, right? So if you're putting that in the speculative part of your bucket, great. If you're putting it as like 10% of your allocation, that's not investing.
Really, really interesting. We've heard a lot about AI here. It's been a constant theme. How is a shop your size looking at that type of technology to make yourself more productive, more efficient for your clients?
Well, so far it's summarizing meetings for us. It's summarizing video conferencing for us. Summarizing internal documents for us. But we've tried to get it to read, insurance policies. It's not working yet. We've tried to get it to read estate plans. It's not working yet. So I mean, look, it is beginning to change the world, and I think in the next 10 years our jaws will drop with what it's capable of doing. But it has limitations today. What it does is it's clearly making everyone more efficient.
Right.
But it's not where it needs to be to really substantively change things the way the internet did. It's inevitable, but it's not there now.
So when somebody comes to you and they're like, look at all the changes, you're like, not yet. It's
They're
not totally happening.
It's not totally happening. It's happening, and it will happen in the next few years, but it's not like we waved a wand and everything got better today.
You did a panel on the Blueprint for Success.
Yes.
And listen, we on Bloomberg, we talk to a lot of folks who write books, and here's the things. How do you kind of lay out how you got to where you are?
So I think to be successful, like in a capitalist society, you got to be one of a couple things. You've got to be high value. People have to feel like they're getting more for you from someone else. You've got to be low cost relative to others, or you've got to be the fastest. Like if you think about Amazon, 90% of the time you buy something on Amazon, it's costs more than going somewhere else. You're buying it because it's just so damn easy. It just shows up at your door really fast. And what I tell my team is that we want to be all three. We want to be lower cost, not rock bottom, but a little lower than our peers. We want to deliver massive value for what the clients are paying us. And we want to be incredibly fast. We want our clients' heads to spin with the speed with which we solve their problems. And I think that's why today we're the leading independent firm. I think it's a competitive landscape, and who knows how this game plays out. But if we're in the second or third inning of the game, we're up by a little bit.
And let me blow a little smoke Peter's way. When we set up our firm, when I set up our WM, we looked around and who do you want to be like? And creative planning. And I'm not just saying, you don't hear me say this ever.
No, you don't.
Creative planning was the shop that we said, these guys have figured out how to do the right service and add value to clients in a way that made sense. And we very much imitate. You and I have had this conversation before. It's a little bit of a log rolling, but we love the idea of being the financial quarterback, and these are the people that establish that.
For investors that are out there here at Bloomberg, really cool stuff to hear you say and to hear the accolades from this one.
High praise from Barry. High praise.
He can be tough.
But it's true.
Is there a book that you think everybody should read? Is there something someone should monitor if they're an investor out there? And we've just got about 35 seconds. Is it what do you tell people?
Not counting your book.
yeah. No shameless plug.
I don't think there's I'm not aware personally. Maybe Barry has one of a firm that of a book that would walk you through how to do it. Barry, do you have
just stay well read or? In general, for investors?
For Winning the Loser's Game by Charlie Ellis.
Yeah, for winning investors. I thought you meant about building a system business. But no, I love Winning the Loser's Game is a great example. Yeah, of course.
All right, fun. Thank you so much.
Thank you, Peter.
Thanks for having me.
So appreciate it. Peter Mallouk, President and CEO of Creative Planning. More to come from Future Proof. This is Bloomberg. This is Future Proof, and I'm Carol Massar along with Barry Ritholtz. Hard to believe we're almost wrapping up here.
I know, it's crazy.
Right?
It's like planning for a wedding, and it's here, and suddenly it's over.
And then you start planning maybe for
the
another
next
wedding.
Right.
All right, we are at Future Proof, Bloomberg Radio's live broadcast from Future Proof. It is sponsored by JP Morgan Asset Management. Now, throughout the day at Future Proof, you know this. You've done some discussions, panels. We had Jeff Gunlock of Double Line. You had your conversation with Joe Lonsdale. There's a lot going on, but we wanted to get to another panel which looked into strategies for a 5% interest rate world, which is, we talk a lot about this, right? Like, what do you do? So let's get to Callie Cox, because she did a panel. She did that discussion.
That name.
Chief Market Strategist at Ritholtz Wealth Management. I know, I feel like...
That's where I know that name
this is
from.
kind of like interesting. Is this funny to do this?
Yeah, me and my boss. It's going to be fun.
As you said, it felt like a performance review. Or getting
Yeah. So be easy on me, Barry.
So, Callie, let's talk a little bit about how you look at the world. You're relatively young compared to old-timers like me. What is the lens that Optimistic Callie, the name of your regular publication, how do you see the world?
Yeah, well, it's in the name, Barry. I like to call myself, I would say I'm an optimist. Of course, I have those risks that I see around me, and I think it's naive to be blind to risk. But in my newsletter that you mentioned, Barry, Optimistic Callie, I try to focus on the context that investors need to understand this rapid fire of information that they're reading every day. Looking back to how markets work, how they've worked in the past, what really matters for the economy. And I bring the data along with me, too. I've been an analyst for over a decade now, and I like to have numbers.
Former Bloomberger.
Former Bloomberger as well.
This is really incestuous,
a reporter in the options market, right?
Yeah, which is big on data, implied volatilities. So, I like to hone in on that background, but also bring it down to an average investor level so anybody can understand how, their money works and markets work.
How do you weed through the information then? I mean, there is so much information out there, but then you've got to weed through and kind of figure out what really matters.
Well, I'm going to go back to my Bloomberg days. Bloomberg taught me how to do size and scope, which was if there's a number or if there's a move in markets that hasn't happened in a while, it's probably important. It's probably news, and there's a story behind it. So that was the nugget that got me started. And I've essentially built my analysis off of that. Of course, I've learned the fundamentals of the stock market. I've learned the fundamentals of the time value of money and compounding over time. But it all kind of goes back to that. If I see a weird jump in prices, if I see a weird move in data, then I dig into the story behind it, and I really hone into that journalist attitude.
So let's talk about size and scope. You recently had a piece that I really liked, talking about 1% days, and you dug into the data of how often we get these 0.5%, 1%, 3% days. Tell us what your research found.
Well, first of all, most days in the stock market are pretty boring, which is kind of crazy to think about because the news is screaming at you every day about how important it is. I think it was more than half of days were 25 basis points, or excuse me, 50 basis points.
53% of the
0.5%.
days. Your data is 53% of the days is 50 bips of 0.5% or less.
Correct. Which is kind of crazy.
So more than half the days, like nothing's really going on.
Exactly. And stock market math is a little weird, right? I mean, when I think about percents, I think about sales, like going to a clothing store and seeing a sale. And if I saw 1% off, a 1% drop in prices, I'd be like, okay, see you tomorrow. Like, give me something a little bit better. But in the stock market, that's actually quite a big day. I mean, about 20%, less than 20% of days
context
are
is
when
everything.
you see a 1% move. So 1% is important. And being able to provide that kind of information can really help an average investor understand those headlines that say, oh my God, the S&P fell 1%. It's important to our clients too, right, Barry? Because we get more questions, more contact with our advisors when they see those headlines and those big moves in markets.
And it's our job to anticipate that and tell people in advance, hey, this is normal. So let's stay with this line. How often do we see 2 or 3% moves in the market?
So that's less often. I know we've seen a couple of those in the past month or so. Barry, you're putting me on the spot, but it doesn't happen a lot. And remember, 20% of days you see a 1% move higher or lower. And you also have to remember a 2% move higher, people care a little bit less about that because we're all happy, we're making money.
Right.
So 2% days, 3% days, they're a lot more rare. I know 1.5% days happen about 10% of the time. And that's the point in my mind where I say this is serious, especially if there's a headline behind it. So, if we see days like August 5th, where the market melted down because of the yen carry trade imploding.
August is just a bad month for stocks. It's often when I go on vacation.
I thought they say that about September.
Yeah,
Isn't September supposed to be a bad month?
It's supposed to be, but I have to tell you, I mean, I often go on vacation in August, and there's always something going on or something bad happening and stuff.
Well, there's not as much volume, so it makes sense.
True.
There's a big gap.
I always used to hear the expression, rookies manning the terminals, because everybody who was senior would be away for the month of August, and they left the kids on the trading desk.
Yeah, you're not wrong. I mean, I go to the beach in August too.
I am curious how you think about the markets as kind of a more efficient clearinghouse, only because there is so much information, and then if there are worries out there, they kind of gets out there, and we will often see kind of a big move in, I feel like, from peak to trough in an individual name or even in the markets, and we kind of clear out some noise, and then we see investors come back in.
Yeah, well, I think you're absolutely right, Carol. I think a lot about that since the drop we saw in 2020.
Yeah.
Being one of the fastest bear markets ever. That
special
rebounded.
Situation.
It was a special situation. I mean, that was a once in 100 years pandemic. But the flow of information is just so fast these days that you do see it manifest in markets. And what that leads to is more emotions, more context that we need to manage on the advisor side. And that's where roles like mine, roles like Barry's are quite important. But
do you
also
guys get a lot more calls when there's like volatility or big swings?
We used to. Early on, the phones would light up, and now it kind of feels like people know our shtick. They've heard us talk about, hey, volatility is normal. There's no upside without downside.
Right.
So we really try and educate client. The time to read the emergency instructions in the seat back on your plane is on the ground, not after the wing comes off in the air. But I want to ask Callie a quick question in our last minute. Everybody's been talking about the Fed. The Fed's going to cut tomorrow. I can't help but feel like that's already in the market. What are you looking at beyond tomorrow's Fed announcement? What should people be thinking about for the rest of the year?
Well, look, Barry, I mean, I think the bond market has already priced in quite a few rate cuts. So, yes, it's already baked into the market. You could hear people argue about 25 versus 50. For the average investor, it doesn't really matter. Minimal economic impact in the first cut. The important thing that markets are going to be looking at is where the Fed will go over the next 12 months or so.
Terminal rate.
Correct. How quickly will they get back to that neutral rate of 3 to 3.5%? That's what I'm watching. I'm looking at the dot plot when we see projections come out on Wednesday. I'm, of course, listening to Powell and his evaluation of the economy. But this 25 versus 50 debate, I mean, gun to my head, probably 25 bips. But does it matter in the long run for most people? No.
Makes for a good drinking game. That's about it.
She's tremendous, isn't she?
Good stuff. Callie,
Yeah.
thank you.
Thank you for having me.
She was a former Bloomberger. Of course she's great.
Fantastic.
Callie Cox, Chief Market Strategist at Ritholtz Wealth Management. Coming up next, VanEck.
Excellent.
Looking forward to that.
This is Bloomberg Businessweek with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, this is Future Proof. What a way to wrap up 2 days of coverage. A treat. I want to get right to it. This is, of course, Bloomberg Radio's live coverage of Future Proof, sponsored by JP Morgan Asset Management. Carol Massar, along with Barry Ritholtz. Get off your phone. We have a special guest.
I'm just looking at my notes.
Well-known, long-time name and firm in the investment world, and it was one of the first asset managers to provide investors with access to international markets. It does a lot more today. Fresh off a panel about what comes next is the CEO of VanEck, Jan VanEck. Firm has about $108 billion in assets under management, nearly $60 billion in the U.S. and international equities. Welcome.
That was great to be here.
This is a treat. You are off a panel, and I want to talk about what comes next. But you guys can invest around the world, lots of places, the U.S. What's interesting right now?
A couple of different themes. One, to start at home, very concerned about the fiscal situation in the United States, right? Everyone knows our deficit's at record historical highs, especially with low unemployment.
And it's different this time around when we were worried. I feel like in the beginning of my career, we constantly talked about the deficit and then it went away.
Exactly. Well, because there's an escape hatch, right, which is called the central bank or the Treasury buys all our debt, which Japan has done and delayed its reckoning, if it's even had a reckoning, for 20 years.
Yeah.
So that's exactly the dichotomy that investors have to face, right? There is this big fiscal deficit, but the bond vigilantes, I don't know if they're on another planet, but they're definitely asleep, right? And treasuries are rallying into this. So I would say, listen, what it means is we're going to be spending less money, regardless. I think we'll have a split government one way or the other. I have no idea how.
Right.
We can't be spending $1 trillion at a clip because we just saw that it resulted in inflation.
So let me push back on that a little bit, because you and I have discussed this in the past, but I want you to defend that. So my whole professional career, I've been hearing warnings about the deficit is going to make it too expensive to service the debt. No one's going to lend to Uncle Sam. The dollar won't be the reserve currency. It'll crowd out private capital. None of these things have happened. And Japan has kind of shown, hey, you could run a debt pretty high level. Their economy still has been doing pretty well. Why is the fiscal situation so dire here, given that we haven't seen any problems?
It's a political, approximation, but I just think spending is going to go down, Barry. So what I say is, if you look at 2022, 2023, 2024, everyone's like waiting for the recession.
Right.
Recession didn't happen. Why? And that's what I say, because government spending was so high.
Right.
So that's really my point. That government spending, unless you get another $1 trillion spending package, which isn't going to happen unless Kamala Harris gets elected and sweeps.
Clean sweep.
Right? If that happens, we'll get more $1 trillion spending bills. But even her party with Larry Summers, I think, is reluctant because of the inflation.
Who? No one listens to him anymore.
Oh, that's true. He's on another planet, too.
He got shunted aside because he was wrong about inflation, wrong about the fiscal spend.
Well, we did get inflation.
Yeah, but he said it was going to be persistent and you would need 10% unemployment to bring it down. It was transitory. And maybe transitory took a little longer than expected. But I want to stay with the idea. We didn't have single-party rule. We had a major infrastructure bill go through.
Money's still working its way through.
We had the semiconductor bill go through. We had the Inflation Reduction Act go through. We've had 4 major pieces of legislation that are all 10-year spending plans.
Yeah.
Why can't that happen if we have a split government going forward?
It can.
All right.
It can. Look, we don't know the future, but I'm just saying there's a lot of bills like Trump's taxes are going to expire. There's another debt ceiling fight. So there's just a lot of turbulence. You're right. Maybe it comes out and we just keep on spending like it's 2022.
So let me give you
So that's one scenario. Then the markets continue to rip. Okay.
Wait, let him talk.
Scenario
Let him
one.
talk. Let him talk.
Scenario tip. To less primary case, Jan's primary case, less government spending. So just like things get a little bit more subdued, and I think the 10-year is reflecting that. Weird outside scenario, the bond vigilantes fly back with an Elon Musk vehicle back to Earth, and they go crazy, and the 10-year freaks out. I agree, low probability. Investors just need to keep that in mind. Long story short, okay, if you need that monetary stimulus, what do you want to own? Assets that are still unpopular, I would say, future-proof. gold and Bitcoin. Both have hit all-time highs, but I'm surprised being at this conference, I have not run into a lot of Bitcoin or gold bulls.
Couple of crypto places, Grayscale is over there, but
No, it's a different tone, right, than we've seen over the last few years.
So what metrics, so let's assume you're right and I'm wrong. What metrics are you watching to give you some insight that, hey, this scenario is playing out?
Just look at the technicals, right? Again, gold and Bitcoin, all-time highs, nice bull
Stock market
markets.
all-time highs, though.
Sure. Yeah, but what... boy, Bitcoin and gold are rallying because of what I talked about, right? The equity market's rallying because we have an AI technology trend in NVIDIA and a couple of companies.
The equal weight S&P actually was hitting all-time highs.
Yeah.
But that's
great.
But that's not just the mega caps.
That's true. Yeah, no, I mean, I'm not bearish U.S. equities.
Yeah.
I'm just saying the way to construct your portfolio is to deal with opportunities, which of course are primarily U.S. equities. But one of the risks on the horizon, which was the original question, right, was what I see is fiscal turbulence.
Right.
And I told you how to hedge it.
So you like gold and Bitcoin. What else do you like?
For that, right.
For that reason.
And then I think Barry knows, when I look forward for the next 10 years, India's economy is going to overtake that of continental Europe. And yeah, you can say the companies are expensive, but there are two phone companies that effectively have an oligopoly over the access to the internet. And India's digitizing.
Really interesting.
I agree. I feel like the shift from China to India is happening in a big way, right? In terms of investor focus.
And people are very open to that story now.
Come back soon.
Okay.
Jan Beck.
All right.
Jan
Good seeing you guys.
VanEck. What a great way to wrap up. We're done.
So much fun. Anytime I get to talk to Jan, I'm thrilled.
Anytime I get to talk to people like Jan and like you, it's kind of fun. That's going to do it for us. I'm Carol Massar along with Barry Ritholtz. I'm going to be in New York for a post-Fed decision. That's going to do it from Future Proof. This is Bloomberg.